Good morning to you. Today is Friday, January 16th of this year, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. So this week, I discuss what boards face during a restructuring window. My observations are on a London Stock Exchange listed company that I'm following, which is undergoing a restructuring and refinancing process. So, a short recap of the week. On Monday, we discussed why refinancing fails after the press releases, and Tuesday, why the headcount-led recovery plans break under scrutiny. On Wednesday, why sovereignty is a mode only when boards demand evidence, and yesterday, why productization is the only lever markets believe. And today, we're going to wrap up the week with the earliest failure signal boards often miss, and this is working capital. So let's separate two things that boards often bundle together. One is profit, and the other one is cash reality. So profit can look fine on paper, but working capital can kill or still kill the company. And there are three problems with this that we're going to cover today. Number one is the UK reporting expectations are increasingly forcing boards to address solvency and liquidity risk clearly. So the Financial Reporting Council going concern guidance is designed to help companies demonstrate the assessment underpinning their going concern conclusions, including solvency and liquidity risks. When working capital becomes volatile, disclosure quality and investors' confidence get tested very, very fast. And problem number two is the insolvency levels remain a live backdrop. So the Insolvency Service reports monthly registered company insolvency figures for England and Wales, and they have stayed, and this report numbers stayed higher versus historic norms, which rolling rates also published. So no need to go and find these figures now, but this is an environment in which the boards operate. Is counterparties get cautious, credit terms tighten, and supplier patience shortens. And it's very serious because it's in the public domain now. So number three is a PLC that I'm observing. The sharpest stabilizer has been working capital swings, not revenue headline collapse, or collapse is a word, but anyway. When delivery, billing, dispute, and supplier terms fall out of sync during integration and restructuring of this company in particular, cash fails first and the P&L only catches up later. So in simple terms, it's like working capital is the oxygen level in the room, and the P&L is a photograph on the wall. So the oxygen levels are way more important than actually the picture you have in the wall, regardless how beautiful it is. So here's the nuance boards need to take seriously. Well, they are serious, but actually they have to observe this very carefully. Working capital is not one thing, it's a chain of things. And let me give you seven of them. Is a delivery cadence, is acceptance and disputes, is a billing cycle, is a collections, the supplier terms, the people cost and subcontractors, and the customer confidence. So you see, several things are involved here. So a working capital collapse is rarely bad luck. It's usually a system telling you it cannot keep pace because there are so many things involved that actually the system have to fall one after the other right away, like a domino effect, right? So if that domino effect is broken, then it's not bad luck, it's because the system is failing somewhere. This is why the negative working capital insight matters. And here's 5 points about this. When supplier trust stop or drops, the terms are tightening. And when the terms are tightening, cash pressure rises, and the cash pressure rises, delivery gets strained because there is no cash there. And when delivery gets strained, dispute rises because people start to ask, where are my services or products or whatever is the case. And again, the cycle fits itself again and again and again. So boards often try to fix this with new money, which is a very clever move, but new money helps, but it's not it does not repair the cycle. So if the cycle is broken, it's like as we spoke this week or last week actually, you have a bigger hole to fix before adding more water into the bucket. So as a board advisor, what I will propose to consider in this case. So number one, treat working capital as a cross-functional control system, not a finance metrics. The Institute of Chartered Accountants in England and Wales, they have a guidance on working capital. It frames as a management of cash flow through the business, including the need to align funding sources and operational realities. So boards should insist on a clear cash conversion story that links operations to cash outcomes. Suggestion number two, demand a cash narrative that explains sources and uses, right? Not just a cash flow statement. The financial reporting labs have a report on disclosures about sources and uses of cash that provides practical guidance on answering investors' questions about cash generations and intended use. And this is a wonderful word here, intended use. This is how boards move from the cash number to a cash story investor can trust, intended use. And number three is, suggestion number three is use working capital to test whether the turnaround is becoming system-led or not. If you are integrating a perimeter, shifting from services to products, or changing delivery methods, boards should require evidence that billing and collections are improved through a repeatable processes, not firefighting. That is how you stop working capital from being a recurring surprise. Um, I'm going to open a bracket here because remember that with perimeter in the context I'm covering this week is that this particular PLC I'm watching is integrating as one group, and that is a perimeter because actually from a company that was mostly on service delivery, bespoke deliveries, now is integrating into a one group and is telling the IP is now productized in software and software as a service and recurring revenues, etc. So this one perimeter, right? But you have a regulatory perimeter too, which is expanding and applies to all companies, not just a particular group. So the one that is expanding now is the cybersecurity and resilience bills that the Parliament put out on the 12th of November 2025, so it's literally 2 months ago, with the stated purpose of reforming and adding to the Network and Information System Regulations 2018 to strengthen the UK defences. And this is not about militaries. When the compliance perimeter expands, in this case, is the trusted supplier status becomes harder to keep through narrative alone, meaning that actually before you can have a story, in brackets, about your trusted suppliers, now is expanding and you have to provide more evidence, right? And systems and processes. So that perimeter is one expanding. One is a compliance perimeter, the other one is the company strategy perimeter. So close the bracket. Here's the board advisor framing I use in these working capital environments. Working capital is where strategy meets reality, right? So if your strategy, as we mentioned, is one group integration, working capital tells you whether the delivery really joins up, right? If your strategy is productization, working capital tells you whether you are reducing bespoke dispute cycles or not. And if your strategy is built on trust and sovereignty, working capital tells you whether customers are paying on time because they believe in you or not. And this is also where board packs also or often fail. They show a working capital number, they do not show the mechanics. And remember that investors and lenders do not fund just the numbers, they fund mechanics, system, companies, and companies are regardless of the people. And it sounds very bad, but actually when I mention mechanics is all these assets that you have in an organization, like system, processes, procedures, automatizations, workflows, etc., that regardless of the influx of new hires or people leaving, this company still resilience through time. So board questions need to be mechanical to the teams. So what drives disputes in this case in terms of cash flow? What drives billing lag? What is the aging profile? What is the top 10 debtor exposure? What is supplier concentration in terms? What is changing this month or last quarter or will change next quarter that we can see already here on today? So why this approach matters is three things: the outcomes, the differentiators, and the risk reduction. In terms of outcomes, the Financial Reporting Council, going concern guidance and related messaging, emphasize credible assessment and disclosures on solvency and liquidity risks. So when boards can explain working capital mechanics clearly, going concern reporting becomes more defensible and less reactive. In terms of differentiators, the insolvency service statistics reinforce the commercial backdrop. In an environment where insolvency levels remain high, counterparties protect themselves more quickly. That shows up first in terms of payment behavior. And number three is the risk reduction, how you help to reduce the risk here. The Financial Reporting Council Lab's cash disclosure work provides boards with a practical template for what good looks like when investors ask, how do you generate cash and what will you do with it? Yes, a very valid question from investors. That is exactly the question lenders and markets ask when restructuring plan claims future free cash flow. Now, what feels the best next step for you today with all this information? So don't ask for a new forecast with different colors. Don't ask or demand for better collections as a vague instruction. So better collection doesn't mean much. Remember, there is a complexity here. There's a cycle of things that are happening in the back end. So ask for the working capital system map, for example. And one action you can take home today is ask management for one-page working capital driver map that shows the top 3 causes of billing delays, the top 3 causes of disputes, the top 5 debtor concentrations, and the specific process changes being implemented that this quarter or next quarter will shorten that cash cycle delay or lag. So if management can produce that page, you have learned something important. The business is still running on heroics and not mechanics. And if you are in the other side, which is an executive team, and your board wants to stop working capital surprises during restructuring, book a structured diagnosis session with your team and map cash mechanics end to end. Build the control evidence and the promise or prioritize operational fixes to restore credibility with the board, the lenders, and investors. So let's pause here today. Today's Friday, so we can reconvene next week, because next week I will cover authorization and capital limits, approvals and disclosures, and you will get a simple checklist your board can reuse to maintain a consistent process in regulated settings. And if any of this information in this series mirrors what you are seeing inside your organization or you would like to do something about, you'll probably want to stay with this series. And if you're interested, connect with me and discuss where you are, where you're coming from, what is your current status, and where you want to go. And an advisory board can help you. Let's have a chat. Just a Zoom call or a DM in LinkedIn will help us to connect and speak about that. So have a great weekend and see you on